Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Tuesday, August 20th, 2019. I wanted to do an update on the markets as well as talk on a few other things. I made mention on the front page today about gold and treasuries actually holding up pretty darn resilient despite the recent bounce in the market. I want to talk about that and what it may mean, or at least my interpretation of what might be going on, and share a few other things with you here, some things I haven't covered yet. Let's start with this. This is a little small here. It's probably not going to show well in the YouTube video. Let me see if I can expand this for you. Okay, here we go. Here's a chart. This is from RBC Capital Markets, and there was an article I came across recently that mentioned that we're looking at asset manager notional net long position for U.S. equity futures. So in other words, these are the stock futures such as NQ, ES, maybe the large contracts on the S&P 500, but these are bets, bullish bets on the stock market. And the gist of the article is we've reached the levels not seen or last seen since the top of the last bear market. Remember, that was before the collapse in 2000. The market peaked back in October 2007, just before, right around this time here, right when the futures peaked, and we had a shot across the bow as well. What this tells us is it's that what I've talked about, recently, and I talked about it last fall. It is excessive bullishness when everybody's on one side of the trade. Here's how it works. Think of it this way, and I'm speaking, generally speaking here, but when the last bull has bought their last share of Apple, Microsoft, SPY, QQQ, whatever it is, there's no one left to buy. In other words, when everybody's bullish, not just in rhetoric, but in positioning, more importantly, I always separate the two. That's why sentiment surveys can be a little tricky. I only use sentiment surveys at extremes, because sentiment survey is, you're not necessarily putting your money where your mouth is. You might talk the bullish talk, check a box that you're bullish. That's how the sentiment surveys are done. Are you bullish, bearish? You think the market's going up or down. Whereas when you look at net long positions, that's the positioning. And so again, you can see that we reached those extremes there. And back in January, remember January 18, the market had a mini blow off top, followed by one of the biggest drops in years. Had another drop again in 2018, last fall. Before this was September 2018 right here. Remember the big, it started, the market topped in late September, started falling from there, and really started gaining downside momentum in October. And so we just happened here. Now, what this speaks of, this is more of a crash indicator. You know me, I'm not a doomer gloomer. I'll tell you where my targets, where I think the market's going, but I don't preach the doom and gloom stuff. And to say that the risk of a crash is high, all I'm saying is the risk of a crash or a very sharp sell-off. When I say a crash, I'm talking maybe something akin, a little bigger or a little smaller than what we saw last quarter in 2018. That was a pretty big and pretty impulsive drop. So those kind of things, all I can tell you with certainty is that the risk is substantially elevated when you have this type of thing. And if you didn't catch, I did a couple of videos back then, before the top even came and right after it came, as to why we were going to go down so far, why I had such deep, large downside targets at the time, even those which were slightly exceeded. And that was because of the fact I said that that mutual funds and pension funds, and this information's out there on the web, I verified it, were too heavily weighted into equities. CalPERS had because these pension plans are coming in short, they're not meeting their projected targets, and one of two things has to happen. They need to either come up with more money, meaning raise the dues for existing members to pay off those retirees, like CalPERS, the largest teachers pension fund, or California Public Employee Retirement System, has all the beneficiaries that are retired and drawing on it. They're being paid by the investment returns within the fund, plus new money's coming in. And guess what? When you don't meet your investment returns, when you fall short of the projected, whatever, I think 7.5%, I forget what exactly it is, anytime you're short, okay, maybe you make it up the next year, but when you continue to miss, then things get ugly. And more importantly, when the market starts to crash, what surprised me is just a year or two ago, and I covered this again at the time, I don't have the stats in front of me, but CalPERS actually upped their equity allocation. To me, I thought that was like putting another bolt in the chamber, playing Russian roulette when you're this far into a bull market. So what's going to happen too is when you're lopsided like this, and the funds are all in equity, pension funds, hedge funds, individual investors as well. Of course, these were asset managers, not individual investors. What happens is you have to start reducing your risk exposure when you start to have that, and that's what happened in 2018 and again last quarter. And I predicted it would most likely happen before it happened, that waterfall selling. And that was, I saw two things at the time. I saw treasuries initially not rallying, and that's where we went long. I said you'll see a flight to safety in treasuries because they are the flight to safety instrument. So when the market started dropping, there were non-believers. We started going down, down, down. Yet treasuries and gold really weren't yet responding, especially treasury bonds. And then finally, towards the end of that drop in 2018, the last leg, that's when treasuries started to take off. Now, here's the thing, and they haven't looked back since. So right now, I wanted to make that mention that there was recently excessive bullishness in the market that, based on the drop that we've had so far, in my opinion, that excessive bullishness has not been purged out yet. That's my thought. There are no guarantees. So again, all I'm saying is that the odds for a sharp sell-off are certainly elevated when you see such things as that, as well as the breadth indicators that I went over yesterday. A lot of those flashing some warning signs there. Those divergences can continue to build for some time. So let's keep it simple. Right now, my convictions on the very near-term direction are not very high, or at least not as high as they were back here recently. I mentioned last week doing some of these videos that my expectation was for a move down, a counter trend bounce, which we got. We hit the uppermost bounce target there, and then we hit it again, and yet we hit it again. I expected after that first leg up, most likely that's usually how corrections evolve. You get that initial leg down, you have a counter trend rally, things get a little too oversold in the near term, dip buyer step in, and then the next leg down starts. This is unusual to see just a blip like that. And again, we haven't really gone up, but we're not going down. So this tells me to just take a step back, keep things a little light. Things aren't playing out exactly the way I thought they would right now. It's again, we haven't exceeded that uppermost bounce target, but yet the price action is a little quirky to me right now. And that's where the market is. So to keep it very simple, and then we'll move on. There's my bounce target range. Or no, I'm sorry, I already covered that before. This is the current trading range. Since this was August 5th, so that would have been the candle before. I can't remember if that was a Friday, if August 5th was a Monday or not. Either way, one trading day after. So we're over 2 weeks now, sideways trading here, and those are the levels to watch. Break to the upside would be bullish, but I have a little asterisk by that would be bullish, and that is the 60-minute charts that I showed you. The market has a lot of work to do. So on QQQ, remember my initial bounce target was 188.37. Well, we popped slightly above it so far a couple times, although we've snapped back. Those were momentum fueled overshoots. So to keep it simple, let's just call that a range now between 188, 189. So you really need to pop much above 189 to get going. But if we do, as you can see on the chart above, the 60-minute chart, there's still a lot of resistance. This was the breakout right here. This was the breakout to all-time highs in QQQ. And I showed you yesterday, remember we came to backtest the bottom on XLK, the tech sector ETF. Well, we haven't even come all the way up there yet. So there's still that possibility to come up there, making a mess with these tools. There we go, come up there. Those two lines, that's pretty much the gap support, and where that breakout failed right here. That's where the bull trap failed. And so to me, that's the significant level right there. And so that would be, we could still break out above that 188, 189 level, but then have it prove to be a little fake out. There's been a lot of energy building in technical analysis when a stock is in a trading range, or even just say a horizontal level. This is how technical analysis works. If you see a level, and let's say it's XYZ stock, and that stock keeps bumping on the $100 mark, let's say that's the $100 mark, bumping, that's resistance. We know that's resistance because every time it gets there, the sellers step in and sell, and the buyers stand aside. And then finally, you break out, that's a breakout. That's how you trade. You identify these levels of resistance and then you buy on a breakout, and ideally you want to see it impulsive. And there's some other things that can go into help to confirm the breakout, such as divergences or like I said, high volume. Now where I'm going with this is the more taps on a level, the more reactions, especially when you're in a trading range like this, usually the more powerful the move is out of there. It acts like a coiled spring or energy building up on a compressed spring, and then you pop out. So we'll watch that here, and like I'm telling you, I'm a little bit skeptical that any breakout. I think at best, my views is if we do pop 189 with conviction, as I said this morning in that post, there's probably a lot of stop loss orders here on shorts. That would be the obvious, let's say obvious place, but a little bit too obvious for me. So I think if the algos, the algorithmic trading programs and money market makers and, the nefarious forces that try to extract money from the retail traders, such as, the trading desks at the big firm, if they try to pop it, if they can do it, lift it up, hit those stop pops, then they turn around while all the shorts are covering, which causes that short covering is buying, causes the market to go up a little more, and then they might turn around and reverse it there. That's what they like to do. So I could see that is, let's just say, my most probable or likely scenario if we pop 189. Now, as I always say, resistance is resistance until unless taken out. So we're still failing there, and if the market cannot surmount that level after 1, 2, 3, 4, well, that was yesterday, this is today, another attempt here, that can be quite bearish too. So I'm sticking with this as my preferred scenario right now, but again, I'm just trying to tell you my convictions weren't as strong as they were back here because of this, because we're piling here. So I'm kind of keeping things light right now, and you're not seeing any new swing trades. It'd be pointless. When you're in a range like this is over 4% from top to bottom on QQQ. Think about a swing trade. Ideally, you're going for, let's just say you're using a 3-to-1 risk-reward ratio on a swing trade that has a 15% price target and a 5% stop allowance, right? Well, when you're in this range, the market's swinging up and down 4%. Most individual stocks swing more than the market itself, so you're going to have those stops hit, and you could re-enter and have it hit again, and re-enter and have it hit again. And that's what happened with our SOX trade, the semi-short trade. It entered, it looked good to me up here, stopped out again yesterday. I'll get to that in a second in this video or post an update there. But again, as long as we're in this chop fest, you're not going to hit that 15% price target before your 5% stop is going to be hit, or at least statistically speaking, the probabilities are against you. So swing traders try to avoid sideways grinds. If I would have saw it coming, I would not have had those trades coming, but I didn't see it coming. I figured we'd break down, and that's also the fact the market isn't playing out as it was playing out as to the T before, going short here, covering here, going long for the bounce, reversing there again. But since then, this is what I'm not crazy about. So that's that. We'll watch those levels, and again, to go back to the daily chart, to keep it very simple, I'm throwing out a lot of stuff, I realize that, but to keep it pretty simple, maybe at the risk of oversimplifying things, but that's the box. Bullish above, but with my big asterisk right there, where maybe just short-term bullish, possibly more. If it goes up more and we take out the highs, I'm just plain wrong. And then of course bearish if we drop down below. I still think that would almost certainly open up the next leg of impulsive selling. This is impulsive selling. This is pretty impulsive selling, and of course you go back to 2018, and this is the good stuff. This is what I'm looking for if those lows can get broken, or at least very much open to that possibility. So that's QQQ. SPY, we'll keep it just as simple. Let me find the right board on SPY. Okay, here we go. Let's see, SPY, we have the 294 level. Again, that was, back from when we bottomed here, that was my max bounce target. So there it is, 294, and the recent lows are, round off about 282. And so, bullish if we pop above, but again, a little asterisk by that, just how bullish, maybe nothing more than a brief stop pop. So I'm saying this for those of you that are short, up to you. This is where trading, the decisions get tough. Do you give yourself a little more room? Somebody asked me yesterday, I got the email, they replied to the the post that went out yesterday on the stock market, and they asked about the SOX short trade. Should I, stick to the stop that was the official stop? I didn't have an alert set. I didn't even notice that until after the market. By the way, you can reply to those emails that go out, but I don't actively monitor that inbox. And I'm talking about the new post notification emails. If you have a question on a trade, best to post it on the site under the comment section of the post or in the trading room. So there's SPY, and again, my point is if SPY does pop 294, you've got the downtrend line to contend with, and quite a bit. I have a lot of lines here, but I can tell you this is the big level right here, because that it defines the recent breakout right here in SPY to new highs. And you can see we were rejected there, finally broke out. So that was a breakout, and this made it a fake out, a failed breakout, meaning a bear trap, or bull trap, I'm sorry. And so that comes in right with the downtrend line, just like QQQ. So to me, if they pop it and give us that stop rate, it might even prove to be a shorting up. That'd be pretty aggressive, but you might just want to wait and see if it fails. So that's my expectation. Let's just say right now my alternative scenario and the more bullish of the two is a little stop pop, a little more upside, and then a reversal. And my preferred scenario, I'm still sticking for, holding out for, expecting I should say, and position for that we fail here, on or below that 294 level, and then along with QQQ go out to take out the recent lows and then trigger the next wave of impulsive selling. We'll probably start to see it build speed and momentum if we do fail here before you even break those lows. My guess is you'd come down into them pretty hard. We've been in this trading range for a while, and the thing about trading ranges is they don't last forever. This thing will break one way or the other sooner or later. Hopefully it won't just be a bunch of whipsaws that throw us around. Hopefully we'll get either that bearish resolution, the fake out, and then a quick move down, or this scenario here. And I'll update it if we don't get either. We'll just continue to do these updates, and like I said, point being, maybe keep things a little light until we have a little more visibility right now, because right now the visibility I have is not, or my convictions just aren't very high. Okay, this is the other thing, and I'm trying to really process this and think through as to what it might mean. I can just tell you it's very, very concerning and quirky market action, and I'm referring to now the strength in Treasury bonds. Okay, so this was back in late 2018. As I told you before, the market started going down. Treasuries weren't responding until after the sell-off was clearly underway. Then you start to see this flight to safety bid, and then what happened is, as we know, remember the stock market exploded off the lows on December 24th and had one of the strongest rallies in history, really. It was certainly one of the strongest in years. Yet treasuries didn't go down. These are the king of risk off assets. When institutions, especially but as well as individual investors, are worried about the stock market, they pull money out. They put them into treasuries because they're safe, they're secure, or relatively safe, I should say. But yet the stock market continued to rally, and so did treasuries. And that's telling me that, look, a lot of people are buying treasuries. There's different reasons, but there are actually two main reasons why treasuries will go up, and one of those, as I said, is flight to safety, concerns about the stock market. The other being poor economic expectation, or declining expectations of future economic growth. I mean, this and everything with the yield curve inversion is telling us that market participants believe we're going into recession. We're going into a very low growth environment. Yet the stock market is not far off all-time highs, and that's because there is this belief, and I believe it's a very dangerous belief, that the Fed has somehow, after all these many, many years and decades of being in existence, they have finally come up with the magic bullet to prevent all future recessions. We're going to have a recession. They cannot prevent it with easy money. They've done this time and time again, and I've showed you charts in the past where I might have, in one of the videos, I may have said always. It's almost always, without exception, much more often than not, after the first rate cut, a recession shortly followed. The Fed cut rates, and they're going to continue to cut because the economy, the U.S. is in much better shape than most of the world, but we cannot weather. If the rest of the world, well, they're already, Europe's already, Germany has already had a negative quarter of GDP growth. Two negative quarters of GDP growth constitute a recession. That's the definition. So everything's rolling over, no end in sight in the trade wars, and yet the stock market doesn't seem to be worrying much, and being not too far off all-time highs, because they think the Fed will prevent it. The Fed has its back, and I think that's setting the stage for maybe a much larger drop, because the stock market is not pricing in future economic downturn, whereas the Treasury market is. That's what I'm trying to get to here. This is a huge run-up in Treasuries, and you can see TLT is at all-time highs, meaning interest rates aren't at all-time lows, close to it. You can look at TYX is the 30-year. You flip its TBT or TLT upside down, I'm trying to say. Yeah, actually, here we are. We're looking at least decade long. Let's go back. Yeah, that's it. So yeah, we're at all-time lows on Treasury yields. Yeah, I guess I did know that. I shouldn't know that we just hit it recently, or there it is. So you can see again, this one, if you weren't aware of where I was going here, this is a 30-year chart, or a little longer. We're going back to the 70s here, late 70s. This is when interest rates peaked. For those of you that haven't been around that long, or haven't studied finance and history, this was a runaway inflation in the 70s leading up to the early 80s there. President Reagan in office, and that's where everything started to, that's where what we call a secular bull market in interest rates ended, and a secular bear market in interest rates. And these are all cyclical bull and bear markets within the larger. You can see the downtrend. This is our secular bear market rates. And as we know, there's really not much more downside. Zero. Well, negative rates are theoretically possible too in the U.S. We already have them in a lot of European countries. But again, I just wanted to show you what's going on here. This is not indicating future economic growth. In fact, this is indicating very bad things to come. And it can be a combination. It most certainly is a combination of people moving money out, people in institutions, into the relatively safe haven of Treasury bonds. But it's also, to a very large extent, forecasting very bad things to come in the economy. And if you read up on this, you can do a Google search, talk to anybody that's been in financing for a long time, and they will tell you the bond market, of the two, the bond market is almost always right, more so than the stock market. Stock market has, and I don't know if it's ever been explained why that is, but one theory I have is that how many of you out there have traded Treasury bonds, or how many have even owned Treasury bonds directly, not in a mutual fund? Very few. Institutions, smart money, the institutional investors tend to trade Treasuries, whereas, no offense, I'm in that group, but the dumb money, retail traders, tend to trade stocks and have more of an interest in stocks than they do in bonds. And so what happens is, it's human nature. The stock market goes up, people buy because it's going up. The higher it goes, the more people buy, and then you get those excesses at tops where valuations are too high, and then suddenly the economy starts to shift, or even future out. Before you hear about the economy really turning, the stock market normally peaks ahead of that in anticipation. So there it is. I just wanted to show you, and again, tell you that I'm seeing a lot of red flags, other than those breadth indicators and things that I covered the other day. This chart of TLT, again, this run up with again, the stock market's only slightly off its all-time highs, especially relatively speaking, but there's been very little give back on Treasuries. And you go down to the 60-minute chart, even there, the stock market rallied the previous 3 trading sessions before today. QQQ rallied over 4%, the S&P 500 almost 4% in just 3 trading sessions. I would have expected, and I did. I had I mentioned this a couple weeks ago as a short. I took a hedge to my short positions by shorting Treasuries. It's not working the way I thought. I mean, I'm barely up on that from where I took it, or might even be flat now. We broke down, and I was using ZB, and I'll show you that chart in a second. This is a very clean pattern to me, a very well-defined uptrend line with very clean negative divergence. What do I mean by clean? Clean separation. I have a clear peak right here in the PPO circle tool here. One peak, a little trough there, and a second peak. And I can do the same on the RSI versus prices making higher highs. That is a very clean example of negative divergence. Normally, you'd expect, especially as overbought as Treasury bonds were on the long-term frames, and the stock market rallying 4% in the last 3 days, I would have expected a considerably larger drop, but it's not happening. There's a strong bid right now for treasuries, and again, that is not a good sign for the stock market, in my opinion. One of the two is going to happen. Either the stock market's going to drop, or there's going to be where everything's fine in the economy, and this was just another scare, and we're going to have another couple quarters of strong earnings and growth in the economy. In that case, the stock market goes up, has another leg up, and there's going to be a mass exodus out of treasuries, because this is a crowded trade right now. And again, it's not, things aren't meshing up real well. Treasury should have been falling, especially this the last few days. And then gold too. Gold's another one. Let me go to this daily chart that has a heck of a run up, has some pretty clear divergences. And again, one of the two things is going to happen here. The stock market takes off, and if it does, be careful, because although I have been and for now still remain longer term bullish on gold, I've said it recently, kind of step back. There are some, you can see here, clear negative divergence right now. So the negative divergences on gold. Last time we had a divergent high like this one's pretty clear, was right here, and there was a pretty good correction. It lasted a while. This is a daily chart. Gold dropped about 6%. If gold dropped 6%, one thing I'm going to tell you is the miners are going to drop a lot more than that. That's a 6.33% drop on GLD back earlier this year, starting around the February highs, and GDX, to try to put it in perspective from that same point, from their highs, GDX fell about 14%, over twice amount. And if you have Nugget, multiply that by 3. Hopefully your position size is adjusted. So there's GDX. I'll move that trend line right there. Negative divergence. So doing this video again to try to share my thoughts that these charts are indicative of a correction, a pretty good correction in the metals and miners at this point in time, if these divergences play out and we get some sell signals here on gold. But gold's been holding up, as treasuries have recently. So it's possible these divergences don't play out. In other words, they just get burned through. But keep in mind, if the stock market breaks out, if I'm wrong and we're going to, and we don't just have a little pop over those highs, but we go on and we take out the previous highs and we make new all-time highs in the stock market, that's only going to be because growth expectations have look a lot better, or the Fed is getting just crazy easy and decide to do, let's say, a half-point rate cut at the next meeting. Market rallies hard. You would probably then see a pretty swift move out of those flight to safety instruments. Maybe, maybe not. I thought we'd see more money come out of those recently with the pop we had in the market, but gold and treasuries are holding up. They've been very resilient despite these bearish technical postures they're in right now. Again, this is a daily chart, and I'll show you ZB, Treasury bond futures. I posted this one today. So again, this would look like, this is just like that TLT 60-minute chart I showed you. If you trade futures, and this is what the institutions tend to trade. They use futures more so than ETFs. But there it is. We broke down. To me, that's a very clear, well-defined uptrend line, clean negative divergences. We had very small divergences back here. Remember, I pointed that out, and we had a correction. It was even a bigger correction than this one. And this one broke a much bigger trend line here. And all we had since the breakdown was that little move and a kickback so far. Treasuries going up with the stock market lately. And, so where they go from here, again, I think if the stock market breaks out above the recent highs, those resistance levels I told you, and especially if it does more than just that little fake out pop stop, treasuries come down. Otherwise, and this is still my preferred scenario, that treasuries are resilient and they'll just burn through these divergences, because like I say, divergences are a big part of my trading, but they're not the be all end all. They're not 100% effective. Look, did it foreshadow a correction? Yes, it did. We had a divergent high right there. That's where the divergences were effective right there, once we had that bearish crossover. And we did have a correction. So it's not to say they didn't work. They just didn't play out to the extent that this pattern might normally. Normally I'd see a wedge this size, and I would say at least we're going down to this 161 target and or that 159.319 target support level. SOXX, like I said, I didn't have an alert set on that yesterday, so somebody asked me after the close on that email, and my reply said, look, I'm sorry I didn't check that earlier, but it wouldn't have changed my response. Whether you're still in it or not, personally, yesterday I would have extended the stop. Remember, everything on there, the stops or the targets are just suggestions. I mean, the targets are levels that I've honed in on. Stops, I'll use a favorable risk-reward ratio. This one may have been set a little tight. I can tell you absolutely in hindsight, again, had I known that we'd be in a choppy trading range, I would have held off. Obviously, that's hindsight. And the fact that the markets had these big swings caused that stop. And again, back to my reply. My response to that question was, I would have given it a little more room. Why? Well, that's simple. Because both QQQ and SPY, just as I updated all day yesterday, were at and failed at. They rallied back to my uppermost bounce targets, which is key resistance. That's the 188.37 level on QQQ. So far, they failed to get through there. That's just a momentum overshoot, but we didn't close the day. In fact, most of the 60-minute candles closed on or below it, and so far again. So as I said, I'm not crazy about this action, but resistance is resistance until unless taken out. And so, in all reality, though my convictions aren't strong, as I said, it's still an objective shorting op. Every time you've got there, you short resistance. That's TA 101 with a stop somewhat above. I'm just, like I said, crazy about the third tag. And so that plays into the my response on SOXS, the short semiconductor ETF. SPY still above resistance as well, the max bounce targets. And so therefore, the semis are really the crux of really the leading indicator in the tech sector, and they're certainly a subsector of the technology sector. Point being that QQQ is almost over half tech stocks. That's the largest component. So if QQQ fails at resistance and moves down, then the semis are going to follow. And so therefore, this is SOX. This is a 60-minute chart, a little breakout there. I'm not crazy about this trend line. There's not a lot of reactions. I can put that trend line like this. In fact, it probably fits better like this right now. I can tell you it does. So there's a trend line, sort of a triangle pattern we're watching. And this is, I know I'm jumping all over the place here, guys. This is SOXX, the non-leveraged. Better to use this when charting, even if trading SOXS, the 3-time leverage. So here's a triangle to watch. Keep it very simple. Bullish on an upside break, bearish on a downside break. But remember, I have a little asterisk by the bullish scenario on the market. And one thing you're not going to see the semis run all the way up here. If QQQ fails here at resistance, it goes down. So that's what I was saying, is that this is, for the most part, it's going to trade right in line with XLK, the tech sector ETF. There can be a little disparity there, but because semiconductor stocks are technology stocks, I showed you yesterday XLK also at resistance, and that was also in my reply to the member yesterday, that I pointed out that XLK had recently broken out. Okay, guys, I may have either skipped over a part of this video. I had hit the pause button to load a new chart and thought I was recording, and I wasn't. So I can't recall if I already went over this before I did that or not. I'm going to do a quick update on the SOX trade if I didn't already cover this part of it. It hit the stop yesterday. A member asked me, Randy, would you stick to that stop and stop out or not? I got that after the in an email after the close, and said, look, I would have given it room for these reasons. Number one, QQQ, which is a very tech-heavy index. Over half of QQQ is made up of the technology sector, a very high weighting. In the semis, of course, are tech stocks. They're part of the subsector of the tech sector. So yesterday we had the Qs at resistance once again for the third, fourth time, even yesterday and again today. And so the fact that QQQ is at resistance, even though my convictions right now and where we go from here aren't very high, or a little less high than before, it still makes an objective shorting op, because like I say, resistance is resistance until and unless taken out. And so therefore, with the NASDAQ 100, very tech heavy at resistance, if it fails there, then the semis are going to go down with it. That's just a given. They're going to move roughly in line with the tech sector. So that's number one. Same story on SPY. Remember, we were at still under my max bounce targets on SPY as well. And then finally, yesterday in the video, I updated XLK and pointed out that this is the tech sector. And the tech sector a lot like SPY and QQQ, also had a breakout to new all-time highs recently, but that breakout proved to be a fake out, or a failed breakout, bear trap, bull trap, I should say, however you want to call it. And so I have this resistance level just below it. There's some gaps in there and reactions, and so the tech sector itself happened to be backtesting at the same time. So for all those reasons, suggested stop is just that. You could have given it room, and even if you didn't, commissions being at a broker, online broker nowadays, ranging from $1, or actually free. Some brokers are free commission, to no more than $7, $8, $10 max. You can always jump right back in the trade. You might want to wait and see, let this market show its hand, and kind of give us some clues whether we're going to fail here, head back down, or we're going to have that little stop raid that I'm talking about, seeing as a possibility. And then the semis itself, let's look at a 60-minute chart. Here's what we're looking at. We have a triangle here on SOX. This is the one-time, the non-leveraged semiconductor ETF. Same index that SOXS trades or tracks, the PhilX SOX, just without the leverage. Better to use this for charting purposes. We have this, nice triangle pattern to watch. So you have, although SOX popped above this resistance level here, and that was a level to note, it does have downtrend line resistance that it's up against now. And so this would be the bearish scenario, and currently my preferred scenario. Could you short it? I mean, it's certainly an objective short here. Like I said, I'm just keeping things light today. Let the market show its hand. I wouldn't be surprised to see that little stop pop raid, but there it is. So we're at resistance on SOX. It really needs to take out that downtrend line, or the uptrend line here, as well as the recent lows. That's what the stock market needs to do. And I can tell you, XL or QQQ, XLK, SPY, if they all take it out, SOX will take it out too. And that should open the door to the next downside there. All right, let's wrap it up here. I'll get this video out to you guys, and we'll see if the market does anything interesting today. I'll post another update.